from the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
Thursday the 23rd, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. In London, I'm Guy Johnson, Alix Steele over in New York. Welcome, everybody, to Bloomberg Markets. Alix, Evergrande on the edge. The Fed and the BOE turning a little bit more hawkish. Stocks are higher.
It just seems like the least to pass resistance is reflation and equities. So you take a look at the S&P up by 1%. But in that, I mean, you have a huge rally in the financials. Neil Dutta had a great quote yesterday that said, we're trading like a reflation trade except for the bond market, because you had that flatter yield curve because you had the shorter end kind of coming up a little bit on those taper indicators, as well as potentially bringing a hike into 2022. Now, however, you are getting a pretty solid sell-off in the back end of the bond market. Yields up by 5 basis points. But over in Europe, this is nothing compared to what we're seeing in the UK. I mean, you have short-term yields flying higher over in the UK, up by about 10 basis points. Dollar a little bit softer, but that's also because you're getting some strength in the cable rate, for example, strength in the pound, I should say. Also, the VIX down under 20. We got through it. It's okay. There were no crazy surprises. We're set up for maybe one hike in 2022, but we'll see. But the transition seems to be set. Guy?
Yeah, I think everybody saw the Fed coming. This was exactly what the script said, and it was delivered upon. And as a result of which, the market is moving on. But it's moving on from taper to rate hikes. And I think that's the debate that will now capture so much of our time over the next few weeks and months. China, though, is front and center. Financial regulators, Alix, in China, issuing a broad set of instructions to Evergrande overnight, telling the embattled developer to avoid a near-term default on its bonds. Let's talk about this. Damien Sassower, Chief EM Credit Strategist at Bloomberg Intelligence, has been covering this story from the get-go. Damien, they're telling them not to default, but they seem to be preparing for that. Is Evergrande about to be made an example of?
Well, Guy, we've come a long way in just 24 hours. I mean, into the Fed meeting yesterday, there was news that, Beijing was going to step in, restructure the company along the lines of what we've seen in the past with H&A, breaking it into 3 separate entities, protecting the interests of the wealth management product holders and whatnot. And, of course, today that's been blown up and set aside. And I'm in conversations with people who own those 8.25 March 22 dollar bonds issued by Evergrande. That coupon income is due today. They have not yet received it. That's $84 million that creditors are waiting for. Now, granted, if they don't pay it, we're subject to a 30-day grace period before the company goes into technical default. But I mean, all indications point to the fact that that payment will not be made, despite what Beijing is pushing the company to do here.
Hey, Damien, quick follow on that. What is the effect in terms of the bond market within China? The knock-on effect?
Yeah, no, I mean, we are seeing losses across the board here. I was just running those numbers, actually. I hadn't finished before the hit. But, the reality is it is right across the screen, and not just over the last few days, but over the last month. And so, yeah, we are seeing contagion spill over into the broader China dollar bond complex. For me, this is going to be whether or not we see it hit the real economy, and all indications point to the fact that it will. We do see, new home sales down. We see secondary home prices dropping. We see, retail sales growth, obviously. And we see China trying to rise to the occasion here in terms of injecting capital into the system. We saw $17 billion pumped into the system by the PBOC this morning, but it's a far cry from what is needed to really stem the bleeding. In fact, I just saw news that China is not paying some employees internally, and certainly suppliers are waiting for their payments as well. So things are getting a little bit worse on the ground.
Yeah, I think it was the EV factory there. Damien, thanks a lot. Damien Sassower of Bloomberg Intelligence. Great analysis. So let's get a deeper look then on the broader market fallout. Abigail Doolittle is here with more. Hey, Abigail.
Hey, Alex. Well, it's really interesting what Damien was just saying about feet on the ground, because everything in life, as you know, is perception. So even though there might be the situation worsening there in China relative to Evergrande, with the idea that the Chinese government is saying don't step in, you've got stocks higher. You can see that the MSCI China index climbed by 0.9% just on that idea of China telling Evergrande do not default, whether or not they do. That's helping out the stock 600 up 1.1%. Of course, Europe has quite a bit of exposure to China. And this S&P 500 really much higher than it had been relative to the futures earlier, up just 0.3% earlier. Now we're looking at a massive two-day rally of more than 2% for the S&P 500. That probably has to do more, though, with the Fed. And then finally, if we round it out with the China tech index here in the U.S., that is down. So that shows some of those nerves that Damien was talking about, down 0.5%. Now, there's been lots of talk about contagion. Is it going to hurt the bond market here? If we take a look at the spread, the corporate spread here in the U.S., this was the bear market here in the U.S., the pandemic crisis. You can see sky high, that as risk fear was really in. Now we see spreads of corporate bonds to treasuries really quite tight, suggesting that there's not a lot of fear, there's not a lot of contagion in these markets at all relative to Evergrande. And then finally, the big question could be, will Evergrande turn into a zombie? A zombie is a company that is technically in default but continues to go on. We can see here lots of growth, especially in real estate over the last 10 years. Consulting firm Kearney, in fact, saying that there's been a ton of growth of these zombie companies in recent years. And the reason? Well, not surprisingly, Fed and central bank liquidity.
Yep, absolutely. The Fed front and center. Let's talk about how the data plugs into what the Fed is going to do next. Abigail, U.S. initial jobless claims unexpectedly actually picking up for a second week. The labor market continues what can only be described as a choppy recovery. The question is, what is the Fed going to do with it? Because on one hand, you could argue that a stronger labor market helps out the doves because the supply and demand side get into kilter. On the other hand, you could argue that a strong labor market helps out the hawks because ultimately that's a strong economy, and actually we need to lean in on that. Mike McKee, as ever, here to answer all of these critical questions. How do you read the Fed? How does the data, particularly on the labor market, plug into the narrative going forward, Mike?
Well, you know, Jay Powell said yesterday that he'd be okay with just a reasonably good September payrolls report. The jobless claims numbers don't tell us a whole lot about how many jobs are added, but they do point to a downside risk for that report because, as you mentioned, there is another increase. We go up to 351,000 from 335,000, revised higher last week. It does suggest that for some reason there are more people losing their jobs. Now, the other half of that is the total number of people who are getting claims. Now, this is 2 weeks delayed, so it's not up to the minute with numbers, but it falls to 11,250,000 from 12,106,000. But it's the day before the benefits were cut off. So next week will be important. We'll see if that benefit cutoff really gets people off the unemployment rolls and then maybe looking for more jobs. This leads into whether or not the Fed does start its taper in November. I mean, bets are that unless it's a terrible report, they probably will. Now, why isn't the market too upset about this? Well, take a look at this chart here. If they start in December with their taper, we still have a couple of months of full $120 billion bought. And then this is the taper, which works out to about $15 billion a month. That's $660 billion still going into the economy between now and next June. So there's still a lot of support out there on the monetary policy side for the U.S. economy.
In the market, though, it does seem like we're trying to reprice the hikes, and nowhere can you see that more than the BOE. You see UK gilt yields soaring higher. I mean, they're really jumping like 10 basis points. What did we learn today from the BOE that is causing that kind of market reaction in contrast with the Fed?
Well, they're suffering not only from the supply chain rebound problems that everybody has, but also from Brexit, and prices, as Guy well knows, are going up, particularly for energy and for food. And that's going to be a long-term problem for the Bank of England. They're now suggesting they might have to raise rates sooner rather than later. Their latest forecast shows 4% inflation continuing well into 2022, a dramatic increase for them. And as you saw the quote there from the Monetary Policy Committee, developments during the intervening period since the last meeting appear to strengthen the case for a rate rise.
All right, Mike, thanks a lot. Really appreciate Bloomberg's Michael McKee. It's wooden slabs, right, Guy? That's the thing you can't get?
That's what I'm after. I'm trying to get, there's certain types of lumber you can't get in the UK right now because they're being imported. You talk to the lumber providers, they are telling you that actually it could take longer even for the stuff they can get because the truck drivers aren't there. Then you take a look at what is happening with petrol stations, gasoline stations, gas stations as you'd call them. BP is basically having to shut down a number of gas stations because it can't get enough drivers to drive gasoline around. There's a Brexit effect in here. Then you've got the energy story. It's all coming together. It could be, as you've been alluding to, a difficult winter coming up for the UK.
It's going to be a tough Johnson household Christmas. All right, we got a risk-on mood still taking hold here. Following the Fed, you got stocks rallying. Bloomberg Dollar Index dropping about 0.4%. You got a move in the bond market. Mark Cabana, BofA Global Research Head of U.S. Rate Strategy, will join us next. This is Bloomberg.
We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. Half of FOMC participants forecast that these favorable economic conditions will be fulfilled by the end of next year. As a result, the median projection for the appropriate level of the federal funds rate lies slightly above the effective lower bound in 2022.
As Fed Chair Jay Powell speaking about the rate outlook and taper timeline yesterday. Joining us now, Mark Cabana, Bank of America Global Research Head of U.S. Rates. All right, Mark, you take a look at what happened to the curve. Flatter yesterday. Trajectory is still flatter, yet today we are seeing a steepener relative to yesterday. We're seeing a move in the long end of the bond market. What is the bond market telling you about what it learned from Powell?
Sure. So yesterday, I think the bond market was telling us that the Fed was a bit more hawkish than anticipated. Today, I think that the market is trying to more deeply digest what the Fed suggested and understand that if downside risks do diminish, this is a Fed that's going to want to hike rates, and that should imply generally a higher trajectory of overall interest rates. So on net, it's a Fed that seems like they want to get going, and if they do, then rates probably need to price in the fact that there will be rate increases in the future, and overall levels of interest rates need to be higher.
Mark, this seems like the meeting that kind of provided the catalyst for the market to move on from thinking about a taper to, as you say, thinking about rates. In terms of the kind of the implications of that shift, what are they?
Sure. So on the surface, Powell had said, we're going to try and disentangle taper from rate hikes. But that's not what the market heard. What the market heard is that there's a lot of momentum for the Fed to taper in November, which is our base case and has been for some time, and then wrap it up by the middle of next year. Now that clears the runway for the Fed to then consider raising rates. And if you look at the Fed's economic projections, well, they do imply core PCE that is expected to be a bit higher than the Fed anticipated in June. And there is building momentum at the Fed for rate hikes. Not only did we see half a hike in 22, 3 hikes in 23, and 3 hikes in 24, but you saw the distribution shift of those dots in 23. You saw only one participant that didn't believe it was appropriate to raise rates at all in 23. So certainly most of the Fed believe that they are going to get going. And if the Fed wraps up taper by the middle of next year, then that does increase the possibility for the Fed to start raising rates by the end of 22, if not very early in 23. So again, I think that it was really the middle of 22 comment on taper that focused the Fed a bit more on the possibility for rate hikes.
So, Mark, let's just say a 6-month window then between ending taper and then hiking rates. Is that enough time? Is the sequencing right? How do you sort of price something like that in?
Yeah, it's a good question. It's worth remembering that in the last cycle, there was a 12-month gap between when taper stopped and the first rate hike occurred. Now, just because that's what they did last time doesn't mean that that's what they will do this time as well. But what it does mean, again, is that if the Fed wraps up tapering by the middle of next year, it clears the runway. And if you think that inflation is going to be a problem, if you think that inflation is going to be materially above 2%, then this is a Fed that's probably not hiking 3 times in 23, but they're going to be hiking 4 times. They're going to need to dial back monetary policy, or dial back the level of accommodation in order to try and get inflation under control. And that means rate hikes. So again, for the market, if you are in the hiking camp that the Fed is going to need to go because inflation's a problem, well then they're probably going to go a little bit faster than the market is currently pricing. pricing, and they could start potentially sooner. Again, that's why getting taper out of the way is so important to the market in terms of when we're going to see a potential liftoff and then how quickly the Fed's going to go.
This economic cycle seems to be happening very quickly, so I wonder whether all these gaps are ultimately going to be compressed. Mark, how should we read the data going forward from here when we think about the debate that you've just laid out about whether or not inflation is going to need more rate hikes than are currently priced? The problem at the moment in the US economy is clearly a supply side one. We've got a huge amount of demand, but we've got a supply side shortage. That's hard to say. If we start to see, for instance, decent prints on the payrolls, does that imply that we're starting to see supply and demand coming back into balance? Does that encourage maybe a slower rate hiking cycle? Or does a full labor market imply that actually we should be having more rate hikes? I'm really confused about which way we should read the data going forward and how the Fed is going to interpret it.
So look, supply side issues are the key question. And what this really means for rate hikes is inflation. That's where the big question is. How long are these transitory impacts, or maybe more persistent impacts on inflation, going to stick around for? And what we have seen, I think is safe to say, is that supply, whether it be labor supply or inputs for goods or services, has just taken a lot longer to come back. And that is going to be the core question that the Fed is looking at. How long are these supply shortages likely to take place? What does that mean for an inflation? And more importantly, what does it mean for inflation expectations? The Fed has told us that they see risks that inflation comes into the high side of their projections, right? They're worried about more upward pressure on prices than what they've penciled into their forecasts. And if inflation persists, let's call it at this time next year, then I think we're going to be talking about rate hikes in the not too distant future. So on rate hikes, the key determinant is inflation. And supply, Guy, as you rightly point out, is what's going to matter most for that.
Mark, it's the rudimentary question. What's your favorite trade right now?
What's our favorite trade? So we continue to like 5-year real rates moving higher. We saw that yesterday after the Fed. We think we're going to see that continue. And we like it for a couple of different reasons. Fundamentally, 5s are going to probably have to price in a Fed that is going to move a little bit faster than the market has anticipated. And break-evens are pretty much pricing a Fed that's going to hit their 2% inflation target. And so 5-year real rates are going to likely be responsible for what moves 5s higher. Also, when the Fed tapers, there's an important technical here where we think that their purchases have had an outsized influence on tips at the front end of the curve. When you look at what they're buying in relation to what the Treasury is issuing, there's a big impact there. So when the Fed dials back, that's going to disproportionately impact tips, we think. Also, the Treasury is going to cut supply in nominals at the November refunding meeting. It's going to probably be the same day that the Fed announces taper, coincidentally. But when they do that, they're not going to cut tip supply. So that's going to be another factor that supports higher overall 5-year real rates. So if you want to play a more hawkish Fed, and if you want to play taper, we think that the best trade for that is higher 5-year real rates.
Mark, always a pleasure. Very insightful. Thank you very much indeed. Mark Cabana, Bank of America Global Research Head of US Rates. We're going to carry on the conversation. Darden delivers why shares in Olive Garden owner are rising despite staffing shortages, pricing pressure, and much, much more. That story next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Applications for U.S. state unemployment benefits rose unexpectedly last week, led by a surge in claims in California, a sign of choppy weekly data as the labor market continues its broad recovery. Initial unemployment claims in regular state programs rose to 351,000 in the week ending September 18th, according to the Labor Department. Iraq Oil Minister Ihsan Abdul-Jabbar says OPEC and its allies are working to keep oil prices near $70 per barrel, according to Reuters. Citing state news agency INA, the official reportedly said the ministry is aiming to keep the price at more than $65 per barrel and that oil experts from Iraq will keep rising 400,000 barrels per month on average. SoftBank is leading a $200 million investment in a robotic startup that helped New York City with its COVID-19 testing process. The move boosted the value of OpenTron's LabWorks to $1.8 billion last summer. The company's robots helped alleviate massive testing delays in New York by saving humans from having to carry out repetitive tasks. And that is your latest business flash. Guy?
Rilke, thank you very much indeed. Olive Garden owner, Darden Restaurants, posting a beat, despite huge headwinds, obviously, with staffing and input costs. Dave Wilson, digging into the numbers.
Yeah, absolutely, Guy. I mean, this is a company that you mentioned Olive Garden. It's about half of their revenue. Another quarter comes from Longhorn Steakhouse. They have a number of other chains as well. Bahama Breeze, Seasons 52, Capital Grill. Put it all together, and you're talking about a company that's more optimistic for its fiscal year that ends next May, raising forecasts for earnings, for sales. In fact, they're now looking at sales at locations open more than a year being up as much as 30%. And as it stands, the sales have already recovered from the hit they took during the coronavirus pandemic. Latest quarter, $2.3 billion, beating estimates. Second quarter in a row, they're around that level. And Darden, I mean, it's been on a tear over the years if you look at their shares. They've risen every year since 2013. They're up more than 35% this year. And if that gain holds up, it would be the biggest advance since that streak began. So Darden has a lot of things going for it at this point.
Yeah, and I should point out, Guy, just so you know, it's unlimited breadsticks is the thing in Olive Garden. You just get this, they just keep coming, and you can get like refill pasta.
Honestly, my family would love that. They'd be all over that.
We have 2 boys. Of course they would. It's like long carbs. Go.
Just keep them coming. Keep them coming.
Exactly. Okay, Dave, the pandemic was obviously a big factor for these kind of restaurants. How has it impacted Darden's operations? Like, are they leaner now? Are they operating more efficiently?
Well, they're trying to deal with it as best they can. But, you just look at where Darden's restaurants are located, you can see that the pandemic would have an effect. 3 of the 4 biggest states, Georgia, Florida, and Texas. And then on top of that, California. So put those 4 together, that's a third of their locations. And, one thing that they pointed out when it came out with the earnings is that they're now expecting costs to be more of an issue than they did previously. They're looking at something like 4% inflation for the current fiscal year in their business, and that's up from about 3% previously. So, it's clear that the kinds of issues, whether we're talking labor or supplies or whatever, that are affecting a lot of companies at this point are showing up with Darden as well.
Yeah, it's sort of like at least everyone's having to deal with it. It just matters of how you then manage it. Hey, Dave, thanks a lot. Really appreciate it. Dave Wilson joining us there. All right, coming up, we're going to stay on food and keep the focus on food pricing and soft commodities. We have seen a huge rally in food inflation all across the globe. We'll break that down in our exclusive interview with David McLennan, Cargill Chairman and CEO. This is Bloomberg.
We've got more orders now than we've ever had in the history of the company, in many products, 6 months plus. So we've got order visibility well into 2022 already. And we would have even more if we would open up more order banks. We've actually stopped taking orders on some of our products because we don't want to set the wrong expectation with farmers.
That was the AGCO CEO, Eric Hansoda, speaking to us last week. So, Guy, the point there was that order demand for all the equipment and stuff, if you're a farmer, is super strong. You have a replacement cycle and really record high food prices. On the flip side, he just can't meet those orders, so he stopped taking any from his order book because there are just so many supply chain issues. Now, this is an interesting chart that kind of highlights that. This is why the demand is so strong. This is the real food price index. I mean, we're nearing the highs that we haven't seen since the 70s, guys. So the demand is definitely there. The inflation in food is definitely there.
Is it going to be transitory? There's so much that goes into this story. We're actually just getting data right now, Alix, from the EIA on natural gas stockpiles in the United States. For you guys, stockpiles are going up. They rose 76 BCF last week. That is exactly the opposite problem that we're experiencing here in Europe. And that has just fed into the food supply chain. Just to bring it back to food, because of what is happening with fertilizer plants, that then feeds into the CO2 problem that we're facing, and it goes on and on. So there's so many linkages in this story at the moment. There's labor shortages on farms. Like, you talk to farmers, friends of mine that are farmers, they're really struggling right now. Dave McLennan is the Cargill chairman and CEO. He's got some unique insight into what is happening here. Obviously, one of the world's biggest ag companies out there with great visibility. Dave, welcome to the program. Thank you for your time. We really appreciate it. It couldn't be better timed. What we're trying to work out right now, what everybody's trying to work out right now, is, are these high prices transitory? Not only in food and energy, your speciality is obviously in the food and energy space. What are you seeing right now? What is happening at the moment? And is this going to be transitory?
Hey, Guy and Alex, good morning, and good morning, everybody. I think it is going to be transitory. Now, this is the dialogue, not just in all products, but particularly in ag and food. And as Alex had alluded to, there are issues in the supply chain, everything from labor shortages to the impacts of climate change, extreme weather events, demand pull for biofuels. So there's a lot of pressure on the supply chain for ag and food. But I think what I've been really struck by in the last 18 months since the beginning of COVID is the resilience of the supply chain, the ability of farmers to figure out how to get their products to market, and for all players to figure out how to get food to where it's needed the most. So I'm optimistic that supply chain issues will clear up over time.
Yeah, and when Guy was pointing out the inventory numbers for natural gas, Dave, part of that is also still going to be the aftermath of Hurricane Ida. If the export terminals aren't there, it's going to be hard to export it, therefore it goes into storage. That also speaks to something that you're dealing with. Reserve in Louisiana hasn't been able to restart because of the storm, and as of now, and I wondered if you could give us an update, any kind of timeline for that, because that's causing some of those short-term distortions.
Well, it really is, Alex, and it couldn't come at a worse time, obviously, at the beginning of the U.S. harvest, and needing to get products from the farm down the river to the port and out for export. We had two facilities that were hit very hard, Reserve, Louisiana, and also Westwego. We've got Westwego up and running again. Our employees have been so resilient. There is a local town where many of our employees live, La Place, Louisiana, and so we've really been focusing on helping them get back on their feet. In many cases, their houses were either destroyed or severely damaged, so I've been very impressed to see how quickly we've been able to get Westwego up and running. But as far as Reserve goes, it's still to be determined. We've had a lot of help, and it is amazing to see in all supply chains, but in that area in particular, everybody's pulling together to get things back up and running, but Reserve is yet to be opened yet.
Dave, it's an interesting point and a wider one. We're all now turning our eyes towards the COP26 meeting in Glasgow. The environment is becoming a greater focus for so many industries, including yours. Are you thinking about hardening kind of what you do in terms of the facilities that you have, building in extra redundancy, just toughening up in terms of your ability to sustain more diverse weather conditions? And how do you think this is going to affect the agricultural sector? We are seeing significantly more volatility. What does that mean for your customers? What does that mean for the wider industry?
Well, for sure, Guy, the resilience and diversity of the supply chain is really important. And climate change is having and going to continue to have a big impact on the growth of agricultural products, not just the production of them, but also how they get transported. I think it's one of the benefits of having a large global agricultural company like ourselves. We have the diversity of supply chains. In other words, in terms of export, we're able to export from either South America or North America. And so there will be a reduction in exports coming out of the U.S. because of Hurricane Ida. But I think the point is you have to build resilient supply chains that are diverse in terms of where the port facilities are located or where you're sourcing your product, which geography. Might be Australia for wheat. It might be the Russian region for wheat as well, South America, North America for soy and corn. But I think one of the benefits of having a large, diverse company is the ability to shift supply chains when necessary, and we've really seen that in the last 18 months.
One more quick question on reserve. What's the holdup in getting it back to operational level? And in the meantime, what are you doing with all the stuff, all the shipments that need to go there?
Well, the holdup is I saw some pictures. The pictures were devastating. Just the damage that was done to the facility, as I mentioned. More importantly, our employees and where they lived and the damage to their communities. So whether they couldn't get to work or we just wanted to focus on taking care of them first. And so it's just a logistical issue, which is we had 85 barges that were scattered throughout that region, throughout the river. Wow. That had previously been lined up for shipping. So it's a matter of, and as I said, we've had several friends. Living Lands and Waters, for example, is one nonprofit that we work very closely with, and they've lent their crews, they've lent a hand in order to help us retrieve the barges. So I think it's only been about 2.5 weeks, but certainly there's an urgency both on the people, but also on the logistics and just retrieving the barges to get them to be able to move. As to your second question, Alex, that means everything backs up. It means whether maybe they have to stay in the field, maybe the crops have to stay in storage longer, but it just reverses everything up the Mississippi River while waiting for things to clear right through that bottleneck known as the Mississippi River Gulf down in New Orleans where they were hit by Hurricane Ida.
It's obviously going to be something that we're going to watch very carefully. The food supply chains around the world are being stressed like never before, Dave. Let's talk a little bit about what you said a few moments ago as well about kind of needing to be bigger, needing to be diverse, needing to have a global footprint. We've got the Cargill, Continental Grain, Sanderson Farms tie-up as a prospect. You're already big in beef. You're moving into poultry. I'm wondering if you can update us on what kind of progress you're seeing there. And I would be interested to get some comments from you on a problem that we're experiencing here in the UK and sort of across Europe, which is that we are seeing high energy prices leading to fertilizer plants being shut down, leading to CO2 shortages, which is hitting the poultry industry really hard. It's hitting the meat industry really hard more broadly. I'm curious to get your reaction to that and whether or not that's something that we could potentially experience elsewhere, for instance, in the United States.
Well, I'll start with the poultry between Sanderson Farms and Wayne Farms and Cargill. We're in the poultry business, and we have been for a long time, just not in the U.S. So we, with our partner Wayne Farms, felt that this was an opportunity to fill a consumer demand. Our customers and also consumers, they want to eat more chicken, and they want to consume different kinds of animal-based protein in addition to beef and fish. So this was an opportunity for us to take the expertise that both Wayne and Cargill have in our global poultry operations to come together to purchase Sanderson Farms. So we expect that will close sometime in 2022. To the second part of your question, Guy, I think people have a new appreciation, or I should say consumers, I hope, have a new appreciation for the complexity of our supply chains, meaning the complexity of ag and food, and rather than just go in a grocery store and think, okay, I'm going to buy this, and all the choices, particularly in developed economies that people have, that there are thousands and millions of people that work to get the crops out of the field and down to the ports and then to a point where they're either put into production for some type of product, but that's all very closely linked. So shortages of CO2, which also can come from different types of manufacturing plants, they all connect. The fact is, the one point that you didn't add to that list, Guy, or what you're seeing in Europe, is the labor shortages. So, we have a turkey facility in Virginia that we're only able to run at 70% of capacity because of labor shortages. So we've increased wages, we've offered sign-on bonuses, we've offered enhanced 401k benefits, on-site health care, daycare. But the fact is, we're still short of labor. And so I think that is something that we really have to watch carefully as it relates to long-term inflation, but also capacity utilization, which there is a shortage of today because of labor shortages.
Hey, Dave, before we let you go, Bloomberg reported that you guys had about almost $5 billion net income for the fiscal year of 2021. You stopped disclosing all that stuff publicly, but I need some perspective on that because you are such a powerhouse in ag trading. Also, you have the metals trading business. You have your fingers in so many different pots, and the volatility that we've seen has got to have been a huge boon for you guys. Can you give me some perspective as to how good you're doing right now?
You know, we have a fiscal year that ends May 31st, and as you know well, Alex and Guy, there was a lot of volatility in ag markets. There was significant pull from China, who were buying corn and soybeans. There was weather concerns, especially in the spring of this calendar year, where we had, concerns about hot, dry weather, which ended up, getting better. So they're not going to be huge crops, but better than people had feared in the spring of this calendar year. But when there's volatility, it means there's opportunities to help our customers manage their risk, help them to hedge their positions. And when you have a trading component to your business, which we do, which helps us manage our risk for ourselves, but also for our customers, there are trading benefits involved with that. We do have a very successful metals trading business, and there has been, again, as you know, in the steel business and metals, there has been a lot of price volatility. So when companies have a trading component to their portfolio, volatility means risk management, it means hedging opportunities, and that was a component of our fiscal year results that you referred to.
We're at a record?
I don't know if that's what the article said, but I'd have to go back and read it.
Okay, Dave, we could talk to you for like half an hour, but we'll let you go. Well, thank you so much. We'd love to catch up with you soon. Dave McGlennon, Cargill Chairman and CEO, thank you very much. And make sure to tune in later on today to Commodities Edge at 1 p.m. Eastern. It's my interview with the Woods Hole Oceanographic Institution president. We'll also talk a lot about those power prices as well and the feed through into oil. We have some politics happening here in New York. The New York Health Commissioner, Howard Zucker, who did help former Governor Andrew Cuomo respond to the coronavirus pandemic, has just resigned. Current Governor Kathy Hochul announced his resignation during a virus briefing. We'll bring you more updates as they cross this. Nope. You go, Guy. You tease now.
Do you want me to go now?
You go.
I have to say that Cargill interview with Dave was one of the most interesting conversations I've had in a long time.
Yeah.
Genuinely interesting on so many areas and such great insight into what is happening around the world. A really, really useful conversation. Coming up, it's the story moving European markets. The Chinese government warning local offices that Evergrande may fail. May fail even. Full fail? Could end up being the same thing. Chen Zhao, Alpine Macro Chief Global Strategist, joining us next to talk about this. How bad could it get? What are the implications of this for the Chinese economy, the global economy? That conversation next. This is Bloomberg.
This is Bloomberg Markets. I'm Riska Gupta, and you're looking at a live shot of the principal room. Coming up, Mark Carney, the former Bank of England governor and Brookfield Asset Management head of impact investing. This is Bloomberg.
The Evergrande situation, it seems very particular to China. There's not a lot of direct United States exposure. The big Chinese banks are not tremendously exposed.
While we must monitor carefully for a spillover effect on financial markets globally, at this point, I don't see this developing into a global crisis.
There is the potential for second and third order impact, particularly on the capital markets and the bond markets. And we've got to stay close to that.
They own everything. They own the land. They own the companies, the banks. They control the news. So I don't see this kind of loss of trust that actually brought Lehman and the whole system down.
There was Noel Quinn's comments there that actually were more concerning. Second round, third round, fourth round effects into the financial markets. Central bankers trying to divert attention away from it, not concerned. But is there the potential for something like Lehman to happen here? I think this whole sort of Lehman story, I think, is probably over-egging the point. Why does it have to be like Lehman for it to be serious? Does it have to be that serious to cause significant sort of aftershocks around the world? We'll find out. We don't know what's going to happen yet with Evergrande. We're expecting news actually fairly shortly on the dollar bond payments. Let's try and get an idea of what is happening here. Alpine Global Chief Global Strategist, too many globals in that, Chen Zhao, joining us now. to dive into this conversation. Let's talk about the Chinese authorities' attitude to Evergrande. This has been a problem that's been growing for quite some time. Tom Orlick, my good friend and colleague, had a great line a little bit earlier on. He said there's a Chinese phrase that says you slaughter the chickens to frighten the monkeys, i.e. you're trying to change behavior by potentially making an example of somebody or something. Is that what is about to happen here, Chen? Are we going to see Evergrande being made an example of?
The right way to say it is to kill a chicken to scare the monkeys. So I think this is probably very
I may have
adequate.
misquoted him.
But anyway, this is an old Chinese proverb. But anyway, this is probably very adequate to describe the situation. That's what I'm saying. This is not a systemic event, because in the end, it's a group of Chinese creditors are owed money by another group of people. And actually, all the debt is most of the debt is denominated in Chinese currency. And I think there's very little third counterparty risk. It's totally different from Lehman Brothers. When you think about the financial institution that actually failing, then you are really worried about counterparty risk, third-party loans and stuff like that. But this is a reasonably simple operation. It is a developer, and its liability is reasonably well-defined. You can see that a supplier and it's a home buyer actually formed the big chunk of its liability. So that's the thing. But I'm trying to emphasize here this. This is the intended consequence of Xi Jinping's deleveraging campaign. And he has been on this thing for a long time, actually, ever since he took over power. In 2013, he has been on this deleveraging and de-risk campaign. And this is a part of that. I think it's a controlled implosion of several big companies. This is one of them. If you recall, there were a bunch of others, like Baoshan Bank. That was also a privately owned bank that actually went bust. And there is also Fortune Land Development. There was also a public listed property company that went bust. Yep.
You're totally right. Like, it's not just Evergrande, that's just the biggest, but there's a lot in there. If we just focus on the dollar bonds, which I appreciate that it's local currency that has the majority of the bonds, but for the dollar bonds, you've seen a rally in prices over the last 24 hours. Is this a good buying opportunity for foreign investors?
I think the Chinese authorities seem to hint that they would like to see the payment of this the interest payment on this dollar bond being honored, but I don't know. I simply don't know how. I think the dollar bond holders are going to have a haircut, probably not as much as domestic bond holders, but I simply don't know where they're going to get these dollar income to pay to honor all this interest payment.
There's some suggestions, 25, 35 cents on the dollar. We'll wait and see ultimately where we end up. This may not be a systemic event, but it is going to be a huge economic event. The Chinese economy has focused on construction, on building stuff for many years. And construction is the biggest portion, from a sector point of view, of the economy. If we were to see Evergrande going down, and we're going to see a ripple effect into other builders as well. They're going to be much more cautious. They're not going to overbuild. They're going to take a much more cautious stance. What is the economic effect of that? And what will be the economic effect of that on global growth?
I think it's pretty obvious that right now what happened is that all the borrowing costs for developers basically have jumped. In the onshore market, probably jumped about a 3-4 percentage point. It was a pretty significant increase. So the borrowing costs for all these developers are higher, and I think there'll be more bankruptcies. And the economic activities in the real estate sector and in the construction sector will respond to that higher borrowing costs, and also the government's campaign to actually slash loans to this sector. So actually, if you look at the Chinese construction activity, construction investment is already contracting. So this will definitely add downward pressure in that sector. And as far as the global economic implication is concerned, I think it's marginally deflationary, and probably is going to be bullish for dollar and probably bullish everything else being equal, being bullish for the U.S. Treasury bonds.
Yeah.
That's how I read it.
Yeah, and we've seen, copper take a hit on that as well, for example. Hey, Chen, good to catch up. Chen Zhao, Alpine Macro, a founding partner and chief global strategist. Thanks a lot. And programming note for you, Bloomberg TV is going to have special coverage of the Evergrande effect airing tonight, 9:30 p.m. New York time, 2:30 a.m. in London. Don't miss it. This is Bloomberg. Are you looking at the bond market here in the U.S.? You're seeing yields kind of spike higher, Guy, but it's not us. It's you guys that's really leading the bond market right now.
It's this Bank of England story. The Bank of England sounding... The Fed was a little hawkish, the Bank of England more hawkish. The Bank of England's got a whole bunch of problems that it's got to deal with. It's got Brexit, it's got a tight supply chain story, it's got higher gas prices. All of this is coming together. The PMI data today out of Europe showing a significant impact in terms of the supply chain story into the economy. Chris Williamson, IHS's chief market economist, is going to be joining us next, business economist. We'll find out more then.